Okay, Pops, we have the latest data, and I hate to say it, but things are not looking pretty. The repocalypse, or what do you prefer to call it?
I don't know, Repo-geddon.
The repo-geddon is happening, Dad. Let me share with you the latest data from Cox Automotive, and I want to get your take on what you think's going on in the market and when you think we'll start to see even more downward pressure on used car prices. But let's just jump right in to the numbers. This is data that is looking at the month of December. I can't wait to get our hands on January data. Dad, it reads, auto loan performance in December saw further deterioration. Loans delinquent by more than 60 days increased by 5.3% and were up 26.7% from a year ago. Whoa.
Yeah, those are some pretty staggering statistics. But I think it's an honest reflection of the current market conditions and the environment in which we're all living today.
Now, the data goes on, Dad. 1.84% of loans were severely delinquent. That is 90 days or more past due, which was an increase from 1.74% the month before in November. And it is the highest rate since February of 2009. What was going on in February of 2009, Pops?
I believe there was the Great Recession. I remember trying to live through that. Yes.
Now, Dad, the staggering and what's the word?
I'm not sure what words you're going for.
Startling. Oh my goodness. The startling numbers.
Yes.
That was bad. In December, 7.11% of subprime loans were severely delinquent. That is 90 days or more delinquent, increasing from 6.75% the month before. This is the highest subprime severe delinquency rate in the history that Cox Automotive has tracked since 2006, Dad. What the heck does that signal to you?
Well, it signals to me that people that have abused their credit in the past and don't have particularly good credit scores, they're living up to their history. Those folks who are deep subprime lenders or borrowers, they've never shown the ability to be able to pay their credit obligations in a timely manner. And this is just a continuation of that. And with the increase in inflation and everything else, all goods continuing to go up, people have to make choices, and subprime borrowers are making the choices that they'd rather have a roof over their head and food on the table than to necessarily make their car payment either 30, 60, or in many cases, 90 days late. They have to make tough choices. And the tough choice right now is, hey, they're going to eat and they're going to have a place to live. And hopefully their lender will work with them as they become further and further delinquent on their car loans.
CarEdge.com, all sorts of free resources back there, Dad. Like what?
Oh, I don't know. What's your car going to depreciate over time? How much is your insurance going to be? What should you expect to pay for fuel? It's all there. All that information in one place.
And let's hit on that, Dad, because the signs are pointing to financial institutions, like you said, quote, working with these customers rather than repoing their vehicles. Let me read more of the data from Cox Automotive. It reads, still, the high level of severe delinquencies has not led to the equivalent growth in defaults, repossessions. Loan defaults declined 13.5% from November, but were up 16.9% year over year. The annualized auto loan default rate in December was 2.56%, which was lower than the 2.98% rate in December of 2019. The default rate in 2022 was 2.28%, up from a low of 1.98% last year, but still lower than the average 2.9% rate in 2019. All this to say, while delinquency rates are up to levels we've never seen before in decades, the default or repossession rates are actually not even back to their pre-pandemic highs. And I think, Dad, that could be an indicator of one of two things. Either banks and financial institutions actually really don't want to be in the car business and repossess vehicles, especially when those repossessed vehicles are worth so much less. There's a huge deficiency balance, which I'd love for you to touch on. Or we're just waiting for the shoe to drop. And it's maybe a couple months from now that the banks realize, okay, we actually need to go repossess these vehicles. But it is very interesting. We talk about a repo-mageddon or a repocalypse, but honestly, we're actually just seeing a delinquency-mageddon.
I sort of like that. What we're seeing is the bank's refusals to want to get into the car business. They are showing that they are more willing to work with their customers today that are delinquent than they had been in the past. And the reason for that is that they know in so many cases they financed so much more than the vehicle was worth that the deficiency balances would be so huge that rather than have to deal with that, they will. It's like they're kicking the can down the road, so to speak, in that they're willing to work with customers to take partial payments, to extend the terms even further, with the hopes that these people get caught up, or by the time that they really do have to repossess the car is closer to its real value as to what's still owed. So I think it's a deliberate choice on the part of the lenders to work with customers and try and keep the repo-mageddon from really happening.
We did the video recently, Dad, the woman who had a Kia Telluride and is $34,000 upside down on her car. Imagine you're the bank who has that outstanding loan. You don't want to repo that vehicle. You're expecting $75,000 in money coming back on the loan, and the car is worth $41,000. If I'm the bank, I never want to repossess that thing. I would work day and night to make sure that customer stays in that car. So we may see an interesting phenomenon, Dad, which is delinquency rates go really high, really, really high, and repo rates stay relatively low. Although eventually you've got to imagine things actually they connect. Delinquencies go up, repos go up, but maybe not.
Imagine being the buyer for the bank that approved that loan, and that if that loan goes bad, at a certain point, people within those organizations are going to start, adjusting their guidelines, reprimanding the people that are approving loans that they shouldn't have approved for the amounts that they shouldn't have approved. It could get very, very interesting. There's a lot of people that bear responsibility in this situation. The buyers at the banks, the dealerships, and most importantly, the consumers who agreed to those pricing, the interest rates, the payments, the terms. So there's a lot going on here, a lot of moving parts, but a lot of people that are responsible for the situation.
Each quarter, we get more data from TransUnion, Experian, other credit companies and financial companies. We'll keep you posted on what's going on with the delinquency rate, the default rates, the repo rates. Very, very, very interesting information coming out of Cox Automotive. And Pops, as always, thank you for your time breaking it down.
Yeah, thanks for being here, and thanks for letting me participate today.